Hello and welcome back to the Basic Accounting series. This is a short video about assets. Now you all must have read the definition in the textbooks. Let's quickly break it down and understand with the help of examples. Now assets as per definition are a valuable resource owned and controlled by a business with probable future economic benefit as a result of past transactions or events. So let's understand the definition. Now, it is a valuable resource. The business will derive some sort of benefit from the assets, and that is the reason we're recording them in the books of accounts in the first place. Now, the definition says probable future economic benefit. Probable means not absolute. So, when an asset, let's take an example, fixed asset or investments or debtors, there is something called as bad debts. So when we record the debtors, we even keep a reserve for bad and doubtful debts. We subtract some amount from the debtors on account of bad and doubtful debts. When we record the fixed assets, we reduce the depreciation, and depreciation is an estimate. Suppose this whiteboard was purchased for 50,000 rupees, and over the years I have deducted the depreciation amount, and now the written down value of this particular board is 25,000 rupees. Do you really think I made the best estimation possible, but when I go to the market to sell this second hand whiteboard, do you think I will receive exact 25,000? No, it's an estimation. So that is the reason we say probable future economic benefit. It is not absolute. The debtors may not pay in full, so we have reserve for doubtful debts. Fixed assets, we may not receive exact value, so we reduce the depreciation, and still it is an estimate, not an absolute value. Investments, they are subject to market fluctuations. So assets do not have an absolute value, they are probable. So the economic benefit that we will receive is probable. Next, future economic benefit. Now this benefit could be direct or indirect. So for example, again same example, this whiteboard by itself is not generating any income for me. So this will generate income when I teach, when I write something here and teach my students, the tuition fees will be received by me. So this particular asset is giving me a benefit, but the benefit is indirect. So probable future economic benefit. Next, owned and controlled. Owned and controlled by the business owns it, not the owners. So we make a separation, a differentiation between the owners of the business and business, two separate legal entities, as a result of past transactions or events. Now let's understand. This owned and controlled means substance over form. Now furniture is owned. What about controlled? Copyrights, patents, trademarks. So these are intangible assets. They are not in their physical form, but still we will derive some sort of economic benefit out of them. So substance over form, it is subjective. Example, goodwill. Goodwill is what? It is as a result of past transactions or events. In the previous years, I've made good profit. I have a brand image in the market, and that is the reason my business has some goodwill. Suppose patents and copyrights. In the future, the publication house can print n number of copies of the book that I wrote. So the patents, copyrights, trademarks, substance over form, owned or controlled by the business. So we have different types of assets like current, non-current, tangible and intangible. This video was about definition. So I hope the definition is clear. Assets are valuable resource, probable future economic benefit, owned and controlled by the business as a result of past transactions or events. That's about assets. We'll cover the types of assets in the next video. Thank you and happy learning.